In 2007, a handful of people started to wake up. They realized that taking something out of thin air, assigning it the highest possible rating, and then leveraging it to the maximum was a bad idea. Well, after the financial crisis, we were told that everything had been fixed and that measures were put into place to make sure this could never happen again. We were also told that the tooth fairy brings us a shiny quarter under our pillow too. You came here for the truth, so let me unveil that for you. There's a time and a place for fairy tales, and this isn't one of them. I strongly believe in tough love. Some people just have to hear it, they have to feel it, and there's only so many individuals out there who are going to look into the issues that are present, whether that's going on in their personal lives, whether that's something that's happening externally, and they are actually able to acknowledge it and then try and do something about it. But this small minority of individuals has to take the brunt of the negativity, and that is truly unfortunate. Most people do not want to wake up to the truth. Look at what's happening right now. Today I'm going to show you some information that should be on the front page of every single newspaper, that should be covered by all of the analysts out there, but instead, what are we talking about? G20, where they go around and they shake each other's hands and they talk about nonsense. Nothing ever productive comes. It's just a bunch of photo ops and garbage, but here we are. Anyway, this right here, the representation of what I'm showing you on the screen, is really not far from the truth. Your home is an asset to you, you might think. However, when you look at it on a deeper level, there are mortgages tied with all of these homes, and the banks are creating an absolute pile of garbage behind it. I'm going to show you what's happening right now, not 2007, not 2006. I'm showing you what's happening now in 2019. JP Morgan brings complex derivatives to a wider audience. I just want to extend a big thank you, a handshake to JP Morgan, making it easy for people to trade derivatives. Fantastic. JP Morgan has stepped up efforts to get more clients trading credit derivatives, including, oh my goodness, synthetic CDOs, through a platform that makes it easier for investors to leverage bets on corporate debt markets. This has been the worry for so many now, and it's starting to really raise some red flags, ringing some alarm bells. There have been a bunch of people that have said nothing's really going on, but corporate debt levels are getting excessive. However, you look into it deeper, and this is just one point of many, we have seen the leverage that is going on, creating things like synthetic CDOs that nobody can understand, nobody can manage it, and guess what? It's all within this same pool of garbage, the CLOs, the CDOs. Any type of derivative is always something that the majority of those investing in it, in fact 99.999% of them, do not understand it, and it will create a problem. Will it be next year? Will it be 10 years from now? I don't know, but I know that it is a problem in the making. The platform is designed to simplify the cumbersome process that investors usually face to trade derivatives, including credit default swaps, Greece, CDS options, fantastic, and synthetic collateralized debt obligations. We heard about this in the aftermath. Nobody was hearing about it in 2007 because everything still seemed okay. However, in 2009, 10, and beyond, we started hearing about this, and they were saying, oh, well, obviously that was a disaster. Well, it was totally obvious, but nobody seemed to understand that in 2007. Looking in the rearview mirror, of course, things seem a lot clearer. When I read the bottom paragraph here, it started to make me think that this is even worse than what it seemed. Rather than taking direct exposure to such instruments, users of the platform can instead buy certificates, packaging together a range of credit derivatives as well as corporate bonds, FX forwards, and interest rate swaps. It then goes on to say that they will be able to use leverage here, however, it take less risk. I've heard this so many times before, and of course it isn't the case, but that's what they're telling them. Trading volumes in synthetic collateralized debt obligations linked to credit indexes are up 40% this year. That's according to our friends at JP Morgan, after topping $200 billion in 2018 on the back of 3 years of double-digit growth. Now, the total quantity is still less than we had back in the run-up to the financial crisis. That's a fact. However, we've seen the growth in CLOs that has gone beyond where we are at for CDOs today. Use any letter of the alphabet, I really don't care what you call it, when you can see that these are all somehow tied to a mortgage product, to a home equity line of credits, to credit cards. Derivatives are always going to be a problem as people start to default. Not when everything is fine, that's okay, but when people start to default, which inevitably happens at some point, this starts to unravel and people feel the pain. I wanted to touch on this point here out of Reuters. Synthetic CDOs once symbolized the kind of financial wizardry that led to the financial crisis of 2008, a decade on. Banks are again staffing up desks to trade these complex products on the back of a growing demand from yield-hungry investors. And what are we talking about here? That's right, negative yielding debt. Right now, as the last time I saw, it was $13 trillion of negative yielding debt globally. This has gone far beyond anything we've ever seen before. So when you're out there looking for returns, you have to take risks, and CDOs, CLOs are just a small part of that. Mortgage bond that vanished during the financial crisis is back. This particular company is issuing debt secured by home equity lines of credit. Does that sound like a good idea to you? Well, of course, it's just a small sum, right? Look at this. Cerberus Capital Management is bringing back a type of mortgage bond that went extinct during the financial crisis. A unit of the private equity firm issued bonds on Friday backed entirely by home equity lines of credit. Now look, it's $174 million. That's peanuts when you compare it to the total. But it doesn't mean that this is all we're looking at. This is one particular company. This is one particular instance. But as I said, CDOs, CLOs, anything in the alphabet, put it all together. I really don't care. What we are looking at today is a mess in the making. It's the same issues over and over and over again. They gave him a AAA rating again. We know what happened last time. Why aren't we learning from the mistakes? I've been talking about the home equity line of credit and how important it is to the financial system and what's been happening, the growth of them. Individuals have been using them to pay off their credit cards and other forms of debt because generally it's cheaper, it's safer, quote unquote safer, and that's why people have been having less delinquencies than they are typically seen back during the financial crisis time frame. As the real estate prices have risen, they've been using that equity in order to pay down the rest of their debt. However, that presents itself with a problem at some point when the housing prices start to decline. We've seen the stagnation in many areas, but as the prices start to drop, we are going to run into an issue. The market for pooling home equity line of credit into bonds took off before the financial crisis. In 2004, securitization peaked at more than $29 billion. Even that, it's not that significant when you think about it compared to the total value of the stock market, of the bond market, or even Jeff Bezos' net worth. Well, home equity lines proved risky in the run-up to the financial crisis because homeowners used them to pull cash from the equity they had built from rising home prices. When home prices fell, borrowers were left owing more than their homes were worth. Many of these bonds made up the loans. They started to unravel or dropped sharply in price. This is what I've been warning about. Let's look at a couple charts here very quickly. Issuance volume of mortgage-backed securities made up entirely of home equity lines of credit. And you could see what had happened during this time frame here, just skyrocketing leading up, but then they started to freak out right around 2006, 2007 especially, and then we really started to feel it in 2008. Origination of home equity lines of credit quarterly, just showing you here that this has been increasing over the past few years. And just for fun, right at the end here, possible Fannie Freddie IPO whets Wall Street's appetite. Imagine what this is going to do. We have these companies here that were literally taken over by the government, holding onto trillions of dollars of extremely low quality debt. And what happened? The taxpayer has to foot the bill. This is a serious scenario that never for a second was even considered to be a unwise choice. But here we are today, simply looking at it as if it didn't even matter. It's truly unfortunate that people need to learn the hard way every single time. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a like, you are supporting me, so I do appreciate that very much. If you want the financial education you weren't taught in school, I have 2 books for you to read. They will break down everything from A to Z. You get all the details of the history, the foundation, the assets, everything. Click the link in the description if you want the audiobook that's available at themoneygps.com. If you want to know what's going on right now in the financial industry, this video is the one you have to watch. Click on it and I will see you there.